So we have talked, so we're talking about trying to figure out the capital costs of the firm, and we're trying to figure out, we're going to get to weighted average cost of capital. And we've already figured out how to do the equity costs. What were the two ways we could do the cost of equity? Yeah, CAPM or security markup line. What was the other one? Yeah, a dividend discount model or dividend growth model. So those are our two ways. Now, I've got good news for you. There's only one way to do that, and that's to look at the yield to maturity. And if the firm, yield to maturity on the bonds, but if the firm has more than one bond issue outstanding, how do you handle it? And the answer is a weighted average. A colleague of mine once told me you could flunk an entire class of people just asking them to calculate a weighted average, and he's not wrong. So I'm going to walk you through how we would calculate a weighted average to get this yield to maturity or cost of debt for the firm. So our firm has three bond issues outstanding. They have bond issue A, B, and C. The price of A is $990. That would be quoted as 99 because bonds are quoted in percent of face value. This one would be quoted as 101, so it's worth 1,010 a piece. And this one is a par bond. By the way, what kind of bond would you call this one? Par, premium, or discount? Premium. Premium. And what's that one? Discount. Yeah, very good. Okay, and then we have the number of bonds outstanding for each of those issues. I've chosen these numbers just to try to make the math a little easier. And now what we want to do is, oh, and by the way, we are also given the yield to maturities for each one of these, but I put them down here because I want to do some math before we start to mess with those. So, how would we figure out the market value of issue A? Any ideas?
Price of bonds.
Yeah, so we're going to take the price times the number of bonds, and I think that comes out to be $99,000. Does that sound right? Okay, and now we've got, we're going to take the price times bonds here, and that's going to be is that correct? Check me with your calculator if you're not someone that can do math in your head. I think that's right. And then finally, we have this one, which is just 10,000. Okay, now, when you do a weighted average, what you're doing is you're taking the value of each thing and dividing it by the total value. What's the next step? Yeah, we got to add up those market values. So this is 1.02 million plus 99,000. What do we get out of that? Say again? Is that what the rest of you get?
1,119,000 is what I got.
Okay, I did have my head, so.
Oh.
Gosh, look at it.
Yeah, he was trying to, you know, it's one thing to be confident if you know what you're doing, right? Okay. Well, you said that, I figured you knew. Okay, so 1,119,000. Now, how am I going to calculate the weight for each one of these things? What would I do here? Yeah, so I'm going to take the 99,000 divide by 1,119,000. And same here, I'm going to say 1,010,000 divide by 1,119,000. And down here, I'm going to take 10,000 and divide by 1,119,000. Now, here's what I would recommend you do with your calculator. I'm going to do these one at a time, and I'm going to store them. So here's what I'm going to do. 99,000 divide by 1,119. Is that right? I'm going to say equal. Now, I could write that down. And there are going to be some things that happen when I write it down. Number one, I'm probably not going to write down the full set of numbers. So I'm going to do, there will be a rounding error. Number two, I'll probably write it down wrong. And number three, I'll probably type it back in wrong. So many opportunities for error, plus I'm extraordinarily lazy. So what am I going to do? Yeah, store one. And then, so I can remember where I stuck that, I'm going to write the number one here and just circle it. Okay, store one, just to make, because I'm paranoid, I'm going to store one more time. Now, the second one, 1,0,1,0,0,0,0, divide by 1,119,0,0,0. Does that look right? Equal. What should I do with this number? Yeah, store two. Now, finally, I'm going to say store two one more time because I'm paranoid. And I'm going to say, what do you think I'm going to store it? 3, right? I'll go ahead and write that number up here. Okay, now I want to check to make sure that I have not messed something up. What's something simple I could do right now to make sure that I've calculated my weights correctly? Mr. Sutherland. What's that? Add them together, and what should they equal? 1. Always got to equal 1, or we've done something terribly wrong. So here's what I'm going to do. I'm going to say recall 1 plus, recall 2 plus, recall 3 equals. Bam, there we go. Man, we're good. Okay, so now what do you think the next step is in finding the average weighted yield to maturity? Yeah, so what I'm going to do is I'm going to take this weight that's stored in location 1, multiply it by 6%, this weight times 8%, this weight times 7%. Now, two ways I can go about that. Number one would involve using parentheses, right? Because we're going to do multiplication, then we're going to have to add something that we're multiplying together and something that we're multiplying together. And what I find is most students are crap with the parentheses. And so here's what I would recommend that you do. We're going to calculate the individual products here, and we're going to save them in locations 4, 5, and 6. Then we'll just add those dogs together. Are you ready? So the first thing we're going to do is say, recall 1 multiplied by 6. I'm just going to leave it as a percentage. Now, I'm going to say store 4. Recall 2 times 8 equal. What should I do there? Store. Oh, come on, I wrote it on 5, thank you. And then recall 3 times 7 equals store 6. So now I've got recall 4 plus recall 5 plus recall 6 equals. I'm getting 7.814%. So that is going to be the number that I'm going to be using for the required return on the debt at the firm. Now, quick way to sanity check or stink test your numbers. This number that we calculate should be somewhere between the lowest number and the highest number, because that's how weighted averages work. Are we somewhere between the lowest and the highest number? Yeah, so there's a further reassurance that we've not messed up. Questions? Just got an itch? It must be going around. Okay. Any questions before we move on from the cost of debt? Okay, now we're on to the weighted average cost of capital, or WACC. So, the weighted average cost of capital is basically the firm's overall cost of capital. hopefully you guys have seen this before. And we're going to take the same weights that we've been talking about. E over D plus E is just the proportion of the capital structure that is equity. And we're going to multiply that by the required return on equity, which we found one of two ways. And then we're going to add the proportion of the capital structure that is debt and multiply it by the required return on debt, which would be that number that we just came up with. Now, there's one more term out here, multiplied by 1 minus T sub C. Why in the world is that term there?
Tax,
Go ahead.
tax, that's tax,
Debt's tax deductible.
yeah.
Yeah, so that's why it's 1 minus T sub C, because when I pay $1 of interest, if I'm paying 25% taxes, that dollar of interest saves me $1 on pre-tax income, which saves me 25 cents in taxes. So that's why that dollar of interest is really only costing me 75 cents. And so that's why that 1 minus T sub C is out there. Any questions? I know you've seen this before, but do you think you should put it on your note sheet so you'll remember it? Yeah, I think so. Okay, now, let's just do a quick, dirty little example here. Our firm is 2/3 debt, 1/3 equity. The equity required return is 15%. The required return on debt is 12%, and our corporate tax rate is 25%. What would you put in for E over D plus E? Read that first line. What do you put in for E over D plus E? Yeah, 1/3, because the capital structure, remember I said that all that represents is the proportion of the capital structure that is equity, and then we've got the portion of capital structure that is debt. So what we've got here is 1/3 times 15%. What's 1/3 of 15? 5. Very good. Okay. Now then we've got 2/3 times 12%. What's 2/3 of 12%? 8. Very good. 8 times 0.75, which is 3/4. What's 3/4 of 8? 6. Very good. So basically we've got 5 plus 6 here gives us 11%. And so that's just a quick and dirty demonstration. You guys hopefully all know how to do that. But now we're going to get into some maybe new territory for you. We're going to talk about more or less risky projects. If you've got a project that is identically risky as your overall business, it's perfectly fine to use the weighted average cost of capital as your discount rate. Let me say that one more time. If you've got a project that's absolutely the same riskiness as your regular business, it's perfectly fine to use the weighted average cost of capital as your discount rate. I'll give you an example here. You guys know what the Nissan Altima is. What's a Nissan Altima? It's a car. Is it a sexy, exciting car? No. Is it loaded with new groundbreaking technology that we don't know the market for yet? No. And so, in other words, it's just a regular ass car, right? Now, what does Nissan make overwhelmingly? Regular ass cars, right? So if we were going to build a factory to do the Nissan Altima, a new factory, we could use the firm's overall weighted average cost of capital as our discount rate. That would be perfectly fine. Now let's discuss a different vehicle. Do you guys know what the Nissan Aria is? Yeah, not many people do. It's kind of a snoozer. It's a brand new electric SUV. And they were kind of late to the market with it, and it doesn't have any superlatives. It's not the fastest, it's not the best looking, but it is electric. Now, do you think we should be using the WACC, or weighted average cost of capital, as our discount rate? Mr. Crawford, why not?
It's not their normal line of business.
Yeah, it's not their normal line of business. Let's talk about all the risks involved in EVs. Number one, do we truly know what the market is? No. And in fact, so what we've seen is governments have been subsidizing these things, and now maybe they're pulling back on that. And when governments pull back, we see this really sharply in China. When the government pulls back on the subsidies, the sales just tank. So, number two, we're like, oh, well, you know, the U.S. hasn't pulled back on subsidies all that much. But do you know what's going on with EV sales right now? You guys have any idea? A year ago, people were following car transporters to try to get their hands on these latest electric car models. Now they're piling up on dealer lots, and there are twice as many days worth of inventory for electric cars as there are for internal combustion cars. Are you starting to see that we don't know what the market is? If the manufacturers knew what the market was, do you think they'd be pumping that many cars out? Absolutely not. Now let's talk about the actual risks of the vehicles themselves. When you are building a car, you want the center of gravity, that is the imaginary point about which the weight is all concentrated, you want that to be as low as possible in the car for handling. And it turns out the batteries are really, really heavy. So are you going to put them on the roof? No, where are you going to put them? Down below. They're sitting below the driver and passenger cabin, right? Now let's think through this. What kind of batteries are being used in these electric cars? Yeah, lithium batteries. And lithium batteries also used in cell phones and laptops. What do we know about lithium batteries that might be dangerous? Yeah, they tend to explode. They tend to catch fire, and it's a fire you can't put out for days. Now I want you to follow the bouncing ball here. We have lithium batteries underneath the seats that might catch fire. Talk about your chestnuts roasting on an open fire, right? That sounds entirely dangerous to me.
Sounds like a Ford Pinto situation.
Yeah! For those of you who are old enough to remember, the Ford Pinto was a death trap. If you tap it on the back, it would blow up. Anyway, so long story short, there's fiscal risk, there's market risk, there's physical risk, right? And so it makes a lot of sense that if we're going to do an electric car project, we should not use our weighted average cost of capital. So there are a couple of ways that we can go about this. And the first one is the best, and that is to find a pure play company in the field of the new project, figure out what their weighted average cost of capital is, and then use it as a discount rate for your project. So, can anyone think of a pure play electric vehicle firm? Yeah, back in the day we would have said Tesla, but then Tesla did something silly. They merged with Solar City, which, by the way, seemed like a seedy backroom deal because Elon's cousin owned Solar City, and Elon was on the board. I mean, there was all sorts of incest going on there. Okay, back to the story. So we can't use Tesla anymore.
Fisker.
Okay, Fisker is a pure play electric vehicle company. Is their stock publicly traded? Yeah, that Rivian is and what I would do is find every possible electric car company, pure play, that was publicly traded and figure out all their RWACs and then take the average of those. Does that make sense? Okay, and that's what we would use as our discount rate. Now, this thing that I'm telling you, I've actually made up this example so that there would be good answers for it. But what happens if you're trying out something brand new that no one's ever tried before? It's going to be very risky. So we know the required return is high. We know that the RWAC would not be a reasonable estimate of the cost, but we really don't know. And that's where it gets really, really hairy. And that's where some companies just default to number two, where they simply bump up for riskier projects and bump down for safer projects. So let's assume that the WACC of the company is 9%. They'll say, well, we're going to bump up 3% for riskier projects. We're going to bump down 3% for safer projects. Now, I'll tell you exactly, in a world full of scumbag humans, what behavior this leads to. We all go to the meeting where we're going to discuss our projects to try to get them accepted. We all want our projects to get accepted. Do we want higher or lower discount rates for our project? Yeah, we want lower discount rates because they lead to higher net present values. Does that make sense? And so what this leads to is a lot of lying. I've been in these meetings, and people will just sit there and lie their butts off about how safe this project they've got, that they're going to go try to manufacture something strange on the moon. They're like, oh no, but it's really, really safe. And you're like, right? I've seen it before. Now, that's the downside to this whole bump up, bump down thing. And by the way, do you think some people are better liars than others? Oh, absolutely. There was this guy named Jason. I won't tell you his last name. That guy could lie his ass off, and the bosses would believe him, and we would accept his projects, and then, well, you can guess what happened, right? Not a good deal. Okay, so that's typically, number one is what we should do. Number two is maybe what gets done, but even worse than that, we see a lot of companies, yes?
I was gonna ask, is the bump up or bump down based on like a standard deviation or of anything, or do they just kind of decide?
No, so we're going to talk in chapter 7 about the idea of some things being arbitrary. It'll be someone's arbitrary decision. Probably, maybe the VP of manufacturing, maybe the controller, maybe the CFO. Yeah, I like the standard deviation idea, but it's probably not going to be that way. Yeah, by the way, and I was guilty of this too, you get out of here and you've got all these scientific things you've been taught, and then you get into the real world and you're presented with a problem that these methods could solve, and you're like, huh, and then you just do something very simple and stupid as your solution to the problem. I would tell you about my own, but I'm very just disappointed in myself for having done it, and I don't forget it. And I would explain it to you, but you'd have to be an engineer to understand it. Okay, back to the story. I did not kill anybody. Back to the story. So, a lot of companies very stupidly do a single rate, and they choose the weighted average cost of capital. And they look at all their projects versus that. Now, we said that the weighted average cost of capital is a perfect discount rate for exactly one kind of project. That project would be ones that are exactly as risky as the rest of the company, like the Nissan Altima factory. But for anything else, that leads to a poor decision. So what we've got here is the vertical axis is the discount rate for the project. The horizontal axis is the beta for the project. Remember, beta is systematic risk. That's what we put into the security market line to figure out what a certain risk should be returning, right? And so we can have a beta for a project just like we can have a beta for a stock. And if we're using the security market line, which we should, then you would have the blue line. For colorblind people, the blue line is the one that's going like this. So the blue line, what we should be doing is accepting projects that return more than the blue line and rejecting projects that return less than the blue line based on their beta. And so that adjusts the target based on the risk, which is what we've been talking about doing. Instead, we have Fortune 500 companies, and I will name 2 of them that I know of, that use this situation right here. Now, it may be Halliburton's got their stuff together since I left, but they were using a single cost of capital, 11.9% at the time that I did my last analysis. That was what they used, and that's what everything, regardless of how risky, that's what it got splashed up against. And I thought, well, you know, once I started studying this, I'm like, wow, I can't believe how stupid we were. But then I remembered, you know, we're just a bunch of good old boys out there drilling holes in the earth. This makes sense, right? That we didn't know any better. But then I was talking to one of our alumni, and he is, his title at the time was the Vice President in charge of the customer experience at Walmart. Now, I actually worked in the Walmart corporate headquarters in winter 1993, spring 1994, over Christmas break. And I was amazed at how many Harvard MBA type folks they had there. And it's since Sam's died, it's just exploded. They bring in all these really, really bright people. And so I was shocked to learn that they are still using a single cost of capital, they call it the hurdle rate, to look at projects. And the rule is that they're going to accept projects with an internal rate of return greater than that hurdle rate. And so Walmart is doing exactly, or at least they were, I don't know why that keeps popping up there. But at least they were making this mistake. Let's talk about why this is a mistake. We're going to talk about two different projects here. The first one is on the left-hand side. It's above the blue line, which means that in truth it is a positive NPV project when we consider the risk of the project. But it's below the weighted average cost of capital. So under the single rate system, you would reject such a project. What's the goal of financial management? Maximize shareholder wealth. It's a positive NPV project. Should we be taking it on or booting it? Yeah, we should be taking it on, but instead we're booting it. Now, the other side, it's even worse, because now we've got a project that returns less than the security market line. Therefore, it has a negative NPV. Goal of financial management is to maximize shareholder wealth. Should we be taking on negative NPV projects? No, absolutely not. But the problem here is, under a single cost of capital, we are going to accept that dog. And so here's what happens. Over time, you end up rejecting these low-risk projects and accepting the higher-risk projects. Two things are actually going to happen. Number one, we are not going to maximize shareholder wealth. And number two, our assets are going to become riskier and riskier and riskier over time. And the reason is because we're rejecting these low-risk projects and accepting the high-risk projects. And it's perfectly fine for your firm to get riskier, 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 as long as you've got the return to go along with it. But they don't. They don't have the return to go along with the risk. The return to go along with the risk is the security market line. They're rejecting the ones that are over it and accepting the ones that are under it. And so two things are going to happen. Number one, the risk of the assets is going to go up. And number two, the value of the firm is going to go down, or at the very least not be maximized like we want it to maximize shareholder wealth. Questions? Okay. Now let's ask this question. Do you think all projects that Walmart would undertake would be equally risky, especially in the world of the customer service experience? No. Let's talk about what's their regular kind of solid everyday thing. The check stand with the checker standing there. That's pretty safe. Number one, if there's a technological error, there's a person there to handle it. Number two, do you think the shoplifting is really big through the regular check stands? No, because they can look in your cart and say, hey pal, what about that flat screen TV? And you're like, oh yeah, I'm sorry, I just forgot to put it on the bill, right? Okay, so that's lowers your shoplifting. Now, let's see, what's another thing that you can think of that they might spend money on to get people checked out?
Self-checkout.
Yeah, the self-checkout. And what do we know about self-checkouts, especially as of late? Say again?
That's all Walmart is.
Yeah, it's all Walmart is, but what has happened to the shoplifting as a result? Oh, yeah. And so Walmart associates are actually trained to approach such scofflaws. Mr. Stone is going to be my scofflaw. And we're like, oh, it looks like it didn't manage to scan that flat screen TV. Damn machines, can I help you out? Right? And if Mr. Stoner is an honest person, he's going to be like, oh yeah, and everything will be fine. If he's a shoplifter, do you know how he responds?
Sucks.
Right? He gets really angry and growly and may, right? And so they're training them to actually, step back and be kind and try to avoid getting hit, which is nice. But what does this all point to? Is the risk of the self-checkout higher or lower than the regular check stand? It's got to be higher. Now, they were looking at a technology, and I'm pretty darn sure that, they may be rethinking this one. And that is to require all of their vendors to put RFID tags in each item. Do you guys know what an RFID tag is? What? Yeah, okay, so it makes alarms go off. Not only that, though, you can actually get them that contain the information, just like the barcode on the package, it can be linked to the price. And so what you have to do is you just throw your crap in the cart as you go, and then you just push it through this reader on the way out the door, and it goes boop, 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 and adds up everything in your cart. And then if you've got a credit card with one of these chips in it, I'm sure you guys have seen these, credit card with a chip in it, it reads your credit card with the chip, charges you on the way out. Does that sound slick? No more waiting in line? I think it's freaking great. Now, what are the risks? If you were a scumbag, and I know none of you are, but if you were a scumbag and you were trying to steal something from Walmart, what would you do? Yeah, you'd find the RFID tag and dig it out, right? And maybe you would replace it with the RFID tag from something cheaper, so your item count would be correct. So if you were stopped by the rent-a-cop, then you would have the right number of items, right? Does that make sense? And the bigger risk, I think, is just simply that it doesn't read the items as they go out. And so, RFID can easily be blocked. Let's assume that you've got a flat screen television and you bought 2 rolls of aluminum foil and you just happen to have them on either side of the TV on the way out. What happens? The TV doesn't scan, right? Okay, so the point to that is that Walmart very definitely needs to be using the blue line, but last I checked, they were using the single cost of capital. Questions? So now we're going to talk about flotation costs and the weighted average cost of capital. And in truth, they really don't have anything to do with each other. Flotation costs have nothing to do with a weighted average cost of capital. You might actually find finance textbooks that say these two things are related, and those people are absolutely full of crap. And I'll tell you why. Flotation, by the way, weighted average cost of capital or the discount rate, that goes on for the entire life of the project, every year, right? Every year. Flotation costs happen at precisely one point, and that is at time 0. At time 0. And here's why. Flotation costs are what it costs us to go out and raise the money that we need to go out and undertake a project. So I need $100 million to buy a factory, or to build a factory. I'm going to have to go out and raise that money. And in order to do that, I'm going to engage someone called an investment banker or underwriter. Investment banker. If I say investment banker, I want you to picture in your head the kind of car you think an investment banker drives. Oh my goodness, maybe an unsuccessful one. Anyone else want to guess about the kind of cars driven by investment bankers? Prius. Maybe for those flaky ESG funds, perhaps. Porsche, and by the way, correct pronunciation in German is Porsche. The E is pronounced right? Okay, it's like bitte means please, has the E on the end. Okay, back to the story. Maybe a mildly more successful one than the Mercedes person. The number 1 sales day for Ferraris in Manhattan is on bonus day at the investment banks. Everybody goes down and puts down their deposit on their new Ferrari. I'm not kidding. Okay, now knowing that, and that's just a freaking bonus, right? Knowing that, what does that tell you about how much money investment bankers make? They make a lot of money, right? Okay, so where do you think the money comes from? The answer is flotation costs. Flotation costs. When you go out to, let's say that we issued $100 million worth of stock. Flotation costs typically 7.5%. 7.5 million gone. And instead of walking away with 100 million, we get 100 million minus 7.5 million, or only 92.5 million. And so what does that mean? If we truly have to raise 100 million, we need $100 million, we've got to raise more. We've got to raise enough not only to cover the cost of our project, but to also cover the flotation costs. And so that's what we're going to talk about here. And by the way, both the cost of the project and the flotation costs are going to be added together to be our time zero cash flow. They're going to both occur at time zero. Now, what do we know about flotation costs for debt and equity? By the way, the process for debt is quite similar. And here's the process that happens. The investment bank buys the securities from the firm. And then they turn around and sell them to clients they've lined up in advance. Could be retail investors, could be institutional investors, mutual funds, you name it. In the meantime, though, between when they buy these and when they turn around and sell them, they are faced with something called inventory risk. Imagine that you are holding a boatload of bonds and suddenly interest rates go up while you're holding on to these bonds. What happens to the value of bonds when interest rates go up?
Decrease.
Yeah, they decrease. Remember, it's like this. And so the value of those bonds decrease, and now they're going to turn around and maybe have to sell them at a loss. That's called inventory risk. Now, with bonds, at least we've got a promised payback pattern. We've got a pretty good idea what the underlying interest rates are. We should be able to value those bonds fairly closely, and so the price risk would basically only be associated with any kind of fluctuations in the interest rate. Think about equity, though. A lot of these firms don't even have positive or profits yet, right? And so the value that people are putting on them has totally to do with growth and the hope that they'll eventually break even and all that other stuff. So what do you think is more accurate, our assessment of the worth of a bond or our assessment of the worth of a share of stock for a new firm? Bonds got to be more accurate, right? It's a whole lot easier. By the way, notice I said a new stock, so we're talking IPO. For an SEO, secondary or seasoned equity offering, we already have shares out there trading, so we have a better idea what these shares are worth. But for an IPO, who knows? I'll give you an example. There was a company called Vonage, and Vonage was providing telephony, which is just phones, over internet. And the first time I saw their ad, I told my wife, I said, that's an interesting idea, but it's too easy for other people to jump into that business. And it turns out it was. And some other people like Uma and some other crap moved in there and did basically the same thing. So Vonage saw that the time was right. They saw that they were about to get, right? And so what do? They go out to do an IPO hoping that other people haven't realized the same thing. And so they actually got the investment bank to pay something like $22 or $17 a share. And they're hoping to turn around and sell these for $22 a share. So it's going to be a pretty nice cut. But during the time between when they bought them and when they turned around and were actually able to buy them sell them via the IPO, the share price, actually, people's assessment of it had dropped to below $17 a share. So the investment banker actually ended up losing money on that deal. Now, knowing all of this, we know that it's less risk to do the bonds, and so the flotation costs for bonds are less. The flotation cost for equity is more. Okay, so we're going to talk some more about how that impacts human behavior here in a bit, but the thing to get, last thing off this slide, is once again, flotation costs are up front. They are in dollars and cents. We will be calculating something called the weighted average flotation cost, but it's only a means for us to then calculate dollars and cents, a time zero cash flow to cover that. That's the only reason we're doing that. Don't ever, ever, ever add weighted average flotation cost and weighted average cost of capital. It's wrong. Don't do it. It's mathematically insane. Questions? Okay, now, how do we handle these flotation costs? Well, remember I told you that debt has a lower flotation cost. So you know what a lot of scumbags would do. In order to get their project accepted, they'll say, hey, let's just fund this one with debt. And sure enough, the flotation costs are lower, and sure enough, their marginal project gets accepted. But if we're trying to maintain a target debt to equity ratio at a firm, what does that mean? It means that the next project has to be funded with equity. And when we fund that next project with equity, then it's unfairly penalized because of the high flotation costs of equity. And so you might have a decent project that gets torpedoed because it's being forced to be funded with equity, whereas the last one was done with debt. So how do we get around this? We make the assumption, regardless of how we end up raising the money, we make the assumption that we are going to raise debt and equity in identical proportions to our current capital structure. We make the assumption that we're going to raise debt and equity in the identical proportions to our current capital structure. Hopefully you guys remember our talk about the trade-off, the static trade-off, and that every firm has an ideal capital structure or optimal capital structure. If you issue debt to fund all your projects, guess what? You're going to drift away from that. If you do equity for all your projects, you're going to drift away from that. So that's why we calculate it this way. Questions? Okay. So here is our formula for the weighted average flotation cost. Do you recognize the weights?
Yeah.
Same ones we've been talking about. The proportion of the capital structure that is equity and the proportion of the capital structure that is debt. That is our current capital structure, hopefully the optimal capital structure. F sub S is the flotation cost on stock. F sub B, flotation cost on bonds. Which one of those is going to be higher? Yeah, flotation cost on stock's got to be higher because of risk. And then this F sub 0 we're going to call the weighted average flotation cost. Now, notice we do not have a 1 minus T sub C here. Interest is treated differently than returns on equity. It's tax deductible. But there is no difference in the tax deductibility of the costs for raising equity and for raising debt. So there's no benefit there to debt like we have with interest. Questions? By the way, should this formula be on your note sheet? Absolutely. Okay, now here's my favorite part. Remember I told you that raising money by issuing stock was the most expensive way we could go. But what if we had internal equity that we could use? Would we have to spend any money to raise that money? No, man, it's already sitting there, right? And where does our internal equity come from? It comes from our addition to retained earnings, which then gets dumped into our accumulated retained earnings on the balance sheet. And where does addition to retained earnings come from? Remember, we've got net income, and then we pay out dividends. Anything more than so if net income minus dividends, what's left over is our addition to retained earnings. So that's where we get our internal equity. That's money that you've earned. It's not money you have to go out and raise. And if you're using internal equity, therefore, F sub S is equal to 0. We still use that formula that we just had up there, but we just plug in 0 for F sub S, and it makes that entire stock term go away. Questions? Okay, let's see an example. Your company is financed with half debt and half equity. The flotation cost of debt is 5%. The flotation cost of equity is 15%. And so the first question is, what is your weighted average flotation cost? If I say half and half, what are the weights going to be? Yeah, 0.5 and 0.5. You'd be surprised how many people can't get that right. It's just so sad. Okay, so we got 0.5 and 0.5. We got 0.5 times 15% plus 0.5 times, 5%. we're gonna add that together and see that our weighted average flotation cost is 10%. Okay, so I've got this project where I need $100 million. If I go out and raise $100 million and my flotation costs are 10%, how much will I have after raising $100 million? 90 million, right? We'd only have 90 million. By the way, the project's gonna cost 100 million, we only have 90 million. Is that gonna work? No. So what we've got to do is figure out how much do we have to actually raise in order to have 100 million left after we do the flotation costs. And so we just talked about how the amount that we need has to be equal to the amount that we raise, to be raised, multiplied by 1 minus f sub 0. And what I talked about was raising 100 million there, and then we multiply by 1 minus 0.10 and got 90 million. That's not enough. And so what we need to do is rearrange that equation. And that will tell us how much we have to go out and raise. It's going to be the amount needed divided by 1 minus the average flotation cost. And so what we're looking at here is 100 divided by 1 minus 0.10, which is 0.90. And then when we do that math, we end up with $111.11111, it goes on forever, $million. And so, out of that $111.11111 million, how much of it is flotation cost? Yeah, 11.11111. All I have to do is subtract the amount that I need from the amount raised, and that tells me how much the amount of the flotation cost is. So, what are we going to do in our NPV analysis? Instead of using a minus 100 million for our first cash flow, we're going to use minus 111.11111 because that's the amount of value that we had to give up in order to get that money. And you say, what is 11.11111 million between friends? Probably not a big deal. Here's when it becomes a big deal. If I figure this all out with 100 million as my initial cash flow minus 100, and my net present value is 5 million, plus 5 million, do we accept or reject the project? Yeah, we accept the project. Now, what if I say, oops, there's 11.111 million in flotation costs. Now what's the NPV of my project? Minus 6.111 million. Did you hear the minus? Do we accept or reject it? Yeah, we got to reject it. It totally changes our decision on the project. So if you're doing this kind of work and you're not including the flotation costs, you may be making bad decisions. And it won't be the problem of rejecting good projects. It'll be the problem of accepting bad projects. By the way, which do you think is more likely to get you fired? Accepting bad projects or rejecting good projects? Yeah, accepting bad projects because there's evidence, right? Does that make sense? Okay. That is the end of chapter 12. And I told you to look through practice and homework and come to class today with any questions that you would like to see me work. And so over to you, what questions do you want to see? You got them?
Not from the practice, unfortunately.
Oh, okay, well,
But I got some from the homework.
Okay, well, go ahead.
Number 3 and number 8.
Okay.
Could be something just like
So you're doing the homework first and then the practice?
that. Yeah.
Because the homework has points and the practice doesn't?
Well, yeah, I like to get things that are due out of the way.
Yeah, okay. So you do, you do better on the homework if you do the practice. Okay, so here we go. Jack's Construction has 80,000 bonds outstanding that are selling at par value. Bonds with similar characteristics are yielding 8.5%. The company has 4 million shares of common stock outstanding. The stock has a beta of 1.1 and sells for $40 a share. The U.S. Treasury bill is yielding 4% and the market risk premium is 8%. Jack's tax rate is 35%. What's Jack's weighted average cost of capital? Holy crap!
Just do this, huh?
Yeah, okay, so here's what you do if you run into one of these on the exam. You skip it, and then you come back to it after you've answered everything else. And here's why. This is going to take a while, right? Because we have to calculate a boatload of stuff in order to do this. So the first thing they tell us is that they've got 80,000 bonds outstanding at par value. What's par value? Unless I tell you otherwise, par value is always 1,000. And so we can say that their debt is equal to 80,000 times 1,000, and that is $80 million. Does that make sense so far? Okay, now we need to figure out the equity. The equity of the firm, they're telling me they've got 4 million shares outstanding and they sell for $40 a share. So that's 160 million, is that correct? If I'm wrong, tell me, because it's going to get hairy from here if we don't get this right. Okay, now, I need to figure out weights for both of these. And so the bottom part is going to be D plus E. By the way, you may also see this written as V, which is the value of the firm. You may also see it written as A, assets. I'm sorry, there's just too many people writing freaking textbooks on this stuff, right? Okay, so here we go. D plus E is 80 million plus 160 million. And that's equal to 240 million. Have I blown anybody's mind so far? Okay, now we can go ahead and figure out the weights. D over D plus E is equal to 80 million divided by 240 million. Now, we're going to do something fun here. We're going to cross off these millions, they cancel out, right? And we're going to cross off these zeros. And now we've just got 8 over 24. So, what's 8 over 24 collapse down to? Yeah, 1/3. Now, we're going to go ahead and figure E over D plus E, and then we'll add those together and make sure we've done it correctly. So, got 160 million divided by 240 million. I'm going to cross out the millions, I'm going to cross out the zeros, and what is 16 over 24 simplified? 2 over 3, right? Now, when I add the two weights together, what should they equal? 1. Is 1/3 plus 2/3 1? Whew, good. Okay, so we've got the weights down now. They also tell us that the required return on the debt is, can anybody guess which number up there is the required return on the debt? Yeah, 8.5%. 8.5%. So we're getting really close here. They also tell us that the tax rate is 35%. And so the only thing I think we have left to calculate is the required return on the equity. Now, what kind of information did they give me that would allow me to calculate the required return on the equity? Yeah, so they've given us information to do the security market line. And so if we're going to do the security market line, I'm going to, let's see. Let's try this. The required return on the equity is going to be equal to, the first thing we're going to throw in there is the risk-free rate. Can anyone tell me where the risk-free rate is in this problem?
4%.
Yeah, it's the treasury yield, 4%. 4% plus. Then we have to have the beta. They tell us beta is 1.1. And then in the parentheses, we're going to have the expected return on the market minus the risk-free rate. They don't give us the expected return on the market. How in the world are we supposed to find this?
Market risk premium.
Yeah, you see that market risk premium? That is the expected return on the market minus the risk-free rate. And so this is just times 8%. And so 1.1 times 8% is 8.8%, plus 4% is 12.8%. And so now I can go ahead and figure out my weighted average cost of capital. So, I'll go ahead and write the formula out here. WACC is equal to E over D plus E times the required return on equity plus D over D plus E times the required return on debt times what?
Minus T sub C.
Yeah, 1 minus T sub C. So let's go ahead and fill these things in. The equity over debt plus equity is going to be 2/3. The required return on equity is 12.8%, plus D over D plus E is 1/3 times, what's the required return on the debt? 8%. Oh, wait a minute, no, what is it, 8.5? Yeah, sorry. 8.5% multiplied by 1 minus, and the tax rate is 35%, 0.35. Now, I want to point something out to you. Perfectly fine to use a percentage here, perfectly fine to use a percentage here as long as they match, right? My answer is going to be in percent. Why can't I use a percentage here? Yeah, you'd end up with something really jacked up and wrong, right? That's why we've got to do a fraction here, yeah, or a decimal. If you cannot remember when it's okay to use decimals and when it's okay to use percentages, always use decimals. Always use decimals and then convert back to percentages. If you can see clearly how this works, then you can do it the way that I'm doing it here. Okay, now let's talk about how you go about doing this in your calculator. First thing I'm going to do is clear this, and I'm going to break this into 2 pieces. And I'm going to save this in location 1 on my calculator, and I'm going to save this in location 2 in my calculator, and then I'm going to add those together when I'm done. So here we go. We can say 2 times 12.8 equals divide by 3. And I'm going to say store 1. Is that the number you get? Okay. Now, I'm going to go over here. Which part of this am I going to attack first?
Minus 35.
Yeah, the parentheses. Remember, order of operations. PEMDAS. Please excuse my dear Aunt Sally. Parentheses, exponents, multiplication, division, addition, subtraction, PEMDAS. Okay, so what I'm going to do here is I'm going to say 1 minus 0.35 is equal to 0.65. I'm going to multiply by that 8.5, and then I'm going to divide by the 3. Is that what you guys get? Okay, what am I going to do with that number as far as storing? Store 2. Very good. Okay, now, how do I calculate WACC here? Recall 1 plus recall 2 equal 10.375%, which rounds to the 10.38% that was our correct choice. Does that help you out? Excellent. Now, what's the next one you wanted to see?
It might be the same, I can't remember.
Is it number 8?
Yeah.
Let's see if there's any difference here. Oh my goodness, yes, there's a difference. notice that in this one, instead of giving you the information to solve the security market line, how are you going about finding the required return on the equity? Yeah, it's the dividend growth model, right? Last month, Jack paid an annual dividend in the amount of 1.593 per share. The dividend growth rate is 4%. Okay, so let's go ahead and figure out. We know that R is equal to D1 over P0 plus G. Does that ring a bell? Now, here's the problem. Have they given us D1 or D0? Yeah, they've given us D0, so we can't use this formula, but we do know that D0 times 1 plus G is exactly the same as D1. Does that make sense? Okay, so plus G. So what have we got here? We've got our dividend at time 0 is 1.593. And we're going to multiply by 1 plus, what's the growth rate? 4%. 0.04. Anytime you're dealing with growth rates, always decimals. Divide by a piece of 0. Do we know the price at time 0? $36 a share. Plus the growth rate of 0.04. So let's go ahead and figure out this required return on equity. $1.593 times 1.04 equals. So there is your D1. Divide by 36, which is a piece of 0. That's your dividend yield right there, 4.602%. Now, last step, I have to add 0.04 equal. So that gives me 0.08602 for my required return on equity. Tell you what I'm going to do. I'm just going to save that in location 1. Store 1. Okay, now we can go back and we can look at the rest of this. How would I calculate the market value of the equity, or E? How am I going to calculate that market value of the equity?
Shares times market price.
Yeah, the number of shares times the market price. And so they say, what, 210,000 shares? And we're going to multiply that by 36. Now, what about the debt? 6,000 bonds outstanding. Oh, and the bonds are selling at 99% of face value. So we've got 6,000 bonds outstanding. Are we going to multiply by 1,000 here? No, what are we going to multiply by? 990. Okay, so that's going to give us our D and our E. I'll wipe this stuff off. Okay, so have I gotten you far enough, or do you need me to take it all the way? You want me to go ahead and take it all the way?
Why not?
Okay, very good. Anybody else have any other questions before I say yes to that? Okay, let's take it all the way. So, can someone tell me what 6,000 times 990 is?
5,940,000.
Says, that number right there? I'm going to go ahead and save that in location 2. Because once again, I'm lazy. Okay, now, Well, what about 210,000 times 36? Is that it? 7.56 million? Is that right? Okay, I'm going to say that location 3. Now, how would I figure out this one? It's just going to be $5,940,000 plus $7,560,000, but we already had those in our calculators in locations 2 and 3. And so what I'm going to do is say recall 2 plus recall 3 equals, looks like 13.5 million bucks to me. Does that look right to you? Okay, so now, how do we get D over D plus E? It's just 5,940,000. Oh, by the way, I'm going to store this in location 4. $5,940,000 divided by 13.5 million. So it's recall 2 divided by recall 4. I'm getting 0.44. Any idea where I'm going to store that? Yeah, store 5. Once you get used to the store and recall life, you won't go back. Okay, now, what about E over D plus E? We're going to have 7,560,000 divided by 13.5 million. And so that is recall, so let's see, store, make sure I said store 5 there. It's recall 3 divided by recall 4. I'm getting 0.56. I'm going to store that in location 6. Okay, now, how do I know that I've done okay on my weights? Yeah, you add them together and they equal 1. Okay, so I think now, finally, we are ready to do our weighted average cost of capital. And so what I've got is the weight on equity, which is 0.56. I'm going to go ahead and write that this is in location 6, multiplied by the required rate of return on equity, which I've got stored in location 1. And what was it? It's going to be 8.602%. Plus, the weight on debt is 0.44. I've got that in location 5, multiplied by the required return on debt. Let's see. Oh, wow, check this out. We've got to figure out the required return on the debt. How are we going to do that? 3 letters we're looking for here. What are they? Yeah, yield to maturity, YTM. So let's go ahead and figure this out on our calculator. And when we do, I'm going to put it in location 7. Okay, so how do I figure the yield to maturity on a bond? Well, you guys should be old pros at this by now, but just in case. Second, clear TVM. What's the par value of a bond? 1,000. So I'm going to put 1,000. Future value. Now, is it semi-annual? No, it pays annually. 7% coupon. What's the payment? 70. Very good. Now, it's how many years to maturity? 4.89. Oh my goodness. And interest. So we're trying to figure out the I per Y. They're selling for $990. It's gonna be our present value, but what do I need to do to it?
Negative.
Negative present value, and then what do I compute?
Or what?
Yeah, compute I for y. Does that look right? 7 1/4, 7 1/4. I'm gonna store that in location 7, and we'll write 7.25%. Now, if I had been doing semi-annual, when I got my I for y, what would I have had to have done?
Multiply by 2.
Got to multiply by 2, right? And then we're going to multiply by 1 minus t sub c. Tax rate in this case is 34%. Okay, and when I get all done with this, I'm going to put this in location 8, and I'm going to put this in location 9. So, let's go ahead and take care of, we've already got this one up, right? So let's multiply by 0.44 equals, so I've got this taken care of, 1 minus 0.34. Will you trust me that that's 0.66? Okay, going to multiply by 0.66, and it gives me 2.105. I said I'm going to save that in, store that in location 9, bless you. Now, let's look at this side. We have recall 6 times recall 1. Oh, did you see that? I did this one in percentages, but I was getting ready to do this one as a decimal. That's not good at all. So there we go, I took care of that problem. Okay, does that look right? Now I'm going to store that in location 8. And if I take recall 8, recall 8 plus recall 9, I get 6.922, and that's the closest to 6.9%. Whoa, man, that was even nastier than the last one, right? Questions?